All right, so let's go ahead and get started. Welcome to the webinar. Again, good morning, good afternoon, good evening, depending on where you are around the world and what time frame you're in or time zone that you're in. So thanks for attending, and also thanks in advance for your participation. Always questions and participation is what makes these webinars, I think, definitely more useful for you. So take advantage of this half-hour time and make sure that you ask away. It always leads to other subjects such as trading psychology or fundamental analysis or some other aspect of technical analysis, and always we can go in and look at the pairs that you want to take a look at. So tonight's title is Retracements, and my name is Brian Kahn. You have my contact information there. You have the IBFX collaborative page where lots of different analysts go ahead and post their commentary, including me, at dailyforextradingedge.com, and then you have my website, jupiterpeakfinancial.com, if you have any questions about exactly what I do as far as my consulting with individuals and helping them go about the financial markets for their own trading personality. So before we get into the things, as always, let's go into the disclaimer. I'll leave this up for just a moment. And definitely this one, which I'll read, the volatile markets disclaimer. In volatile or fast-moving market conditions, stop and conditional orders become market orders to be filled at the prevailing price, which may be vastly different from the desired price. Stop loss or conditional orders do not always guarantee fills, and such orders may not be filled as placed. Substantial losses may still occur. We did have larger than average trading ranges today. I will talk about that using some examples today. So again, no guarantees out there no matter what type of order execution you are using. So outline, we'll go through a quick fundamental analysis catch-up. The big events, macro and micro events, I've had to segment these as there is a major difference now between what I consider on our economic calendar to be a major event or a minor event. Technical analysis, intermarket relationships, I'll talk about that. I've been writing about that a lot lately as far as a new relationship that I found. And then obviously getting into retracements, how to track the markets and then actually draw a retracement and then trade the retracement that you drew using short-term and long-term examples. And again, as I said, please ask your questions throughout. I'll try and check the panel and make sure that I'm getting to them, but I'll do that in a review. I'll make sure I hit on all those questions, and I'll give you some links for other resources. So I cannot stress the importance of fundamental analysis enough, because that's definitely what's driving the markets right now. No matter what market you're trading, whether it's equities, whether it's options, whether it's foreign currencies, whether it's futures, whether it's commodities, it's definitely a fundamentally driven market. So let's discuss the current events and what they mean for traders and investors. Obviously, use your broker to stay on top of things. I'm going to touch on fundamental analysis, so it's great to stay on top of the commentary that the collaborators, that the analysts are providing for you, such as the daily market commentary and obviously these webinars. A great way to stay on top of the news. Again, you can use various sites. You can use TV stations such as CNBC and Bloomberg, sites that you use. But a good one a great one that is linked right from the IBFX site is forexfactory.com. So we're just going to jump in there because I just want to stress some macro and micro events. So we'll jump into the internet here. And so today, Thursday, we did have some micro events. So in USD, we had inflation data, and inflation data is a very micro event because obviously the Federal Reserve has said we don't care if there's inflation, we don't think there's inflation, and even if there is inflation, we're still going to be accommodative. They're not changing their stance. So we'll keep an eye on it, but it's not important until the Federal Reserve tells us it's important. But what is important, and this is what I've been writing on a daily basis, the equity markets have been surging to the upside, and that's been causing the U.S. dollar to strengthen, or not causing, but there's been a relationship there. And I've talked about as long as fundamental data comes in positive, or at least close to expectations, I think it'll fuel the rally. And we know that the equity market has been rallying day after day after day, and we have seen week after week after week the jobs data getting better and better and better, and most data out there in the U.S. economic calendar getting better and better and better. But again, this is micro data because it's taking a backseat to the big macro fundamental data. And what do I mean by macro data? Well, I mean SNB, Swiss National Bank Monetary Policy Assessment, when they're talking about interest rates for a specific currency, because you may not be living in that region of the world, but you might be trading another currency like the USD or the euro or the pound or the Australian dollar against the Swiss franc. So just keep that in mind, that no matter what, if there's an interest rate meeting, you need to know about it because it could affect the pair that you're trading. So ECB monthly bulletin, we had Royal Bank of Australia, we had Governor Kent speaking. So there was a lot going on, and we did have a huge move in the Australian dollar as a result of that. So the macro data is fundamental data that's affecting the interest rates as a whole, and that's usually governments talking, presidents talking, or central bank heads talking. So make sure you use that calendar to stay on top of that. Tomorrow, Friday, to wrap up the week, we have a little bit of micro data in the U.S. and for the most part, micro data around the world. Nothing too major around the world, but we did have a good amount of speakers going on previous to that this week. So you just need to stay on top of that economic calendar and use it that way. So that's the fundamental catch-up. That fundamentals are definitely getting better around the world. That's what I believe. That's what I see, and I think that that's causing equity markets to continue to rally. Moving into technical analysis, what are the trends? Can we see where people are buying, which is support? Can we see where people are selling, which is resistance? Can we use intermarket relationships to help give us an edge? And I wrote that they've broken down as of late, and when I did this webinar, meaning when I created it about a month ago, so we can get through compliance over at IBFX, they had broken down in a way of what I was seeing, but I've actually found a new intermarket relationship as of late, and I'm going to show that to you. So I like to use intermarket relationships. If this market is doing this, can I use that as knowledge to say this market may do this? Again, no guarantees, but I like to use ancillary markets to help me give me an edge. And again, an edge is not a guarantee by any means. All it means is an edge is telling me that I think I have a trading plan here with predefined risk and predefined reward. But again, I've got to manage it because it's not a guarantee that it's a reward. It's not a guarantee of the amount of risk because anything can happen at any time. A macro fundamental event could come out and move things opposite of what I thought. So I have to obviously manage it. So no guarantees. All a trading edge is basically I'm starting to create a plan using my analysis. So let's go in, before we get into retracements, let's just get in and talk about some of these intermarket relationships in this technical analysis. So first, before I go into Forex, I'm just going to move into the IBFX sister company. I'm going to move into the TradeStation platform. And I have the S&P pulled up here, and I actually do have a Fibonacci retracement on it. This data that I'm kind of pulling up and focusing on is basically from right here around mid-November. So about 4 months of data, November, December, January, and February, and then into March. And you can see the equity markets, how they've rallied. And what I want you to focus on is that anytime the markets dip, aside from this dip here, after the end of the year and the beginning of the year in January, that was when the fiscal cliff was going on, which was a fundamental event driving that. Ever since that's been worked out, you can see that the markets, the equity markets have been going up, and overall the decline, the retracement has been very small. So I drew a retracement. I measured this move from 135 up to the move here at, and I'm sorry, I got to move the panel here, up to about 153, so about 20 points. And as it backed off only a small amount. You can see 23.6, the smallest retracement we have, and then it went and made a new high. So the point is that the equity market has been trending in one direction, and the retracements overall have been very, I can't stress it enough, very small. Any dip has been, as you can see, a buying opportunity because it goes higher very quickly. It doesn't dip for long. Okay, so that's a look at the equity markets and how much they're trending. But another thing I want you to think about, again, fundamentally, are they bullish because fundamentals are getting better? Are they fundamentally better because the Federal Reserve and central banks? But if you look at the data here, forgetting about that retracement over on the right side, look, we've been up here in 2000. We've been up here in 2007. and we're up here now. What's going to happen? We've never really traded above this level ever before. So now there are some technical reasons to say, could it retrace from this level? And if it does back off and retrace, that's when you can start drawing your Fibonacci's. But you can't draw Fibonacci's until it retraces. So really, I need to remove this because we're at new highs, and until it retraces, I can't do anything about it and use a retracement. So that's just a quick look at the S&P as far as the broad index, as far as the equity markets and what they're doing. Most stocks are following that S&P. Some obviously are a little bit different. A lot of you may follow the bellwether like Apple. Apple has obviously retraced a lot from its high, and I can just type that in just so you guys can see it. And we can pull up, it's been trending down, but if you pull up more data, you can see now you can maybe draw Fibonacci, and it's been trending for so long, but this is exactly what we do, is we draw Fibonacci's. I try and find the genesis of the move, the beginning of the move, out to the end of the move. So I'm just going to draw this. I told you I wasn't getting into Fibonacci's, but we may as well get into it now. Why not, right? So you draw it from the move here. That's one huge up move to the top, and you can see it retraced around 50% or so. So you have to ask yourself, is 50% a good enough discount for you to get in? So remember, as we move into Fibonacci's, and I'll touch on one intermarket relationship before we do that. But as we touch on Fibonacci's, they're not a holy grail. They don't tell us where things are going. They don't tell us when or where to get in. We're using it as an analysis tool, just like a chart pattern, just like a moving average, just like a trend line, and saying, I believe this Fibonacci retracement is going to be support or going to be resistance. And then I use that, and I think it's going to bounce and hopefully roll up or down depending on which way I think it's going to go. So some people are looking to buy Apple at a discounted price, and they might use a Fibonacci line to do that. Who knows? There's a lot of support down here. Maybe it'll get down there, and they might say past support and a Fibonacci line. That might be my area to get in. But going back to the S&P, we know it's trending to the moon, and I just want you to do a quick run through with me as we move now applications and move into IBFX Metaphor Trader. Let me just bring up the pound. Which way, since about the same period of time, November, December, where do you see the pound going? You see it going straight down against the US dollar. So stock market's rallying and the pound is decreasing, meaning the US dollar is going up. Euro, all right, since about that same time, November, December, a little bit different. November, it really is kind of in the same place from that same point. So the euro really is in the same place as the markets rallied and rallied and rallied. It strengthened and then it weakened. Australia dollar, and again, I talked about fundamental events being the drivers. Remember the Royal Bank of Australia, they were speaking right here. That big move was off of someone speaking off of that event. But looking at the larger picture, intermarket relationship, since November, December, what has the Australian dollar done? It's weakened, it's strengthened a little bit now, and we'll show that retracement in just a moment. That's a good one to look at. But it has weakened a little bit in that same time frame. Same thing on a daily basis. New Zealand dollar definitely has gone down since November, December against the U.S. dollar. So the U.S. dollar strengthened. Then we can flip it around and we can look at the U.S. Canadian. And if this relationship is true, U.S. should be going up. The U.S. dollar should be going up. And there you have the U.S. dollar going up. As we know, oil prices did come back down a little bit, so that might be a little bit to do with it. But again, the relationship, stock market is doing better, and the relationship has been, as of late, the U.S. dollar has been getting better as well. So that's an intermarket relationship. If the stock market goes higher, will the U.S. dollar go higher? I don't know, but that's what's been happening in the past. That's what you have to think about. And again, it comes back to time and it comes back to location. So now let's get into retracements. And I told you I'd go into long-term retracements and short-term retracements because all of you are different kinds of traders out there. And some of you are long-term traders, some of you are short-term traders. All right, and again, if you have questions, please ask away. That's what this webinar is all about. So let me just jump back into the presentation here. So we talked about trends. We saw trends in different markets, support, resistance. We'll start to get into that because that's what Fibonacci's basically are, is we're using retracements to give us support or resistance. Talked about intermarket relationships. They really haven't broken down as of late. They've just changed because years ago it was equity markets down, U.S. dollar up. All right, now it's equity markets up, U.S. dollar up. So things are changing out there, and they could change again. It all depends on this global currency war as far as central banks duking it out to have the weakest currency. So what are you finding that's giving you a trading edge? We're constantly searching as traders. Retracements, how to track a retracement, how to draw a retracement, creating trading plans using those retracements and helping those Fibonacci retracements to define your, or using those Fibonacci retracements to define your risk to reward using that support and resistance, all right? And then we'll go into short-term versus long-term. So again, I'll switch these applications. A lot of you are day traders. A lot of people use foreign currencies for day trading. I definitely believe you have to have a larger account size to be a longer-term trader in foreign currencies. So I'm guessing most of you are, kind of in that shorter-term class. So let's do that first. And today, in my market commentary on my website and on the Daily Forex Trading Edge, I wrote about the Great British Pound US dollar. So daily, we know it's been going down. But today, that intermarket relationship broke down because equity markets went up today off better fundamental news. Claims were good. Inflation was in check. And so you're used to equity markets going up, U.S. dollar going up. And today, equity markets went up and the U.S. dollar got smashed against the pound as it went up. And it went up big today, above its average trading range. And I wrote about one of my favorite trades, the Buffalo Bounce trade. So our low price today was down around 49.23. We went up to 50.23, so that's 1 penny right there, 100 pips. And then we went up to 51 even right around there. So we went up 170 pips today, well outside the average trading range. These are what trading ranges used to be like 2 years ago before the equity markets rallied, and volatility dropped off. So much bigger than expected in this. When we have larger than average trading ranges, I talk about a standard deviation trade called the Buffalo Bounce, and some of you listening are probably aware of that because I do talk about it a lot and try and point those out. So today, if you're looking at a trend today and you have these moving averages on, if you remember my last webinar from 2 weeks ago, I did talk about moving averages. So just for the sake of keeping things clean and sticking to the topic tonight, let's go ahead and take everything off here. All right, so we'll take those off. So as far as Fibonacci's go today, you have to ask yourself, when the pound went up, did it retrace a lot or a little? So if we draw this move from here to here, or you could do here to here, it doesn't matter much, but the point is, no matter where I draw it, this move right here, this big move, this explosion from 49.26 up to 50.30, so basically 100 pips, it could only retrace about 20 pips or so. So you have a huge move up, a 23% retracement, just like we saw in the equity markets, and then another huge move up. So that's your clue right there, that when it doesn't retrace much, you have a big move up, like 3 steps up, 1 step down, most likely it will try and keep going in the same direction. And I can draw this again. All right, here's another big move up. All right, let me click on my Fibonacci. So big move up. And again, so another 100 pips roughly, okay? If we look at this, 50.09 to 51.19, 110 pips, it only retraced around 38% or so. And so big move up, relatively small retracement, 38% was your support level. Again, it's now, the banks are closed in England. The banks are definitely closed in the United States, so we're not opening for a few more hours, over in England. So we'll have to see if this trend carries through. Again, the overall trend, you have to keep in mind, has been down. So I'm not saying that we're just going to start reversing and going up, but obviously it was a very strong move today, one side. So if you were day trading today for your 15, 20 pips, whatever it may be, 7 pips, whatever the range was giving you during your time frame, you were probably leaning towards the trend is your friend, and you found out something, whether it's fundamental or technical, and buying today, obviously, the move was bigger to the upside than it was to the downside. It was a trend update in the pound today, right? But looking at that longer term picture, if you look at the daily chart and we do it the other way, if I go ahead and delete that Fibonacci and I do it the other way, all right, and you're a longer term trader and we draw the Fibonacci from the beginning of the move, so maybe some people might do it here or here, and you do it to the bottom of the move down here, we've retraced a very small amount. So we're still very, very close to the lows that we could reverse very quickly and go back down there. So people are looking now to see trend is down. Where can I find a Fibonacci retracement maybe to say fundamentally and technically this is a good place to be short the pound? It's come up too far. Is that the 23% mark? Is that the 38% mark? That obviously remains to be seen. So that's what we're looking at with the pound. The long-term traders, all right, even if you're a short-term trader, you kind of want to know this, and you might be licking your chops when it comes back up here and it bounces 200-300 pips and you say, hey, it's overdone. It can't go any higher based on fundamentals, based on technicals. I'm going to use this line and I'm going to set up a trade. So to set up a trade on the longer term, if you're going to use, let's just pick the 38%, just pick it randomly for this example. Again, no buy, hold, or sell recommendations. 53.80. If you say I want to get in right around 53.80, you might set a limit order, that again is not a guaranteed price. It's going to turn into a market order, so it's really a conditional order. So that conditional order gets filled somewhere in that area, depending on how volatile the markets are, and you might put it at 53.79, 53.75. You don't have to be exact because this might be a longer term trade, and based on your analysis, you say, I believe it can go back down 75 pips, 100 pips, 150 pips. Well, if this is your resistance line, thinking it's going to hold and go down, then you put your stop just above it, 30 pips above it, 50 pips above it, 60 pips above it, and then you try and get your gain on the other side as it rolls down. So we're using these Fibonacci lines just as support and resistance, just as we would use a trend line, just as we would use a moving average, and just like we would use a neckline in a head and shoulders or in a double top or a double bottom, breakouts, things like that. So all we're doing is saying, I believe it can turn around here based on this reason and this reason. Maybe I line it up with a moving average. Maybe I line it up with a fundamental event. But again, it's not a guarantee. I'm just using it to say, I believe that the pound is overdone and too high at this level, and I think it will roll down due to this and this. I'm going to put my entry here. I'll put my stop up here. I'll put my target here. I'm risking 1 to make 1.5. I'm risking 1 to make 2, whatever it may be. Okay? So, but keep in mind, overall, the equity markets have been retracing a small amount and then going back up, but they're at really multi-year high levels, so we're not sure what's going to happen. And obviously the pound, the same thing. It's been not anywhere near multi-level highs or lows, but it has been trending down, and the retracements have been very small when it comes back up. This is a little bit bigger retracement than we're used to, and nothing to say that it can't keep going. But again, the trend overall has been down. Maybe this 23% area right here and all this kind of resistance right here, and maybe a little bit of support there, support/resistance. Maybe there's some, something to be said about that 52-ish area. And if we look at a longer term chart, if you look right here and line this up right here, about 52.50, so that area of old support comes right in around 52.70, 52.50 in that area. That's right around the 23% area. So maybe that kind of gives you a plan of saying, hey, is this old support here at 52.50-ish going to be new resistance? Can I line that up with one of my Fibonacci levels, put a stop above, put a target below, and that's my reason to get short in the pound against the US dollar. That's the kind of stuff that traders are looking to line up. I call them moons. Hopefully you're lining up 2 or 3 moons instead of just 1 moon. Not to say that 1 moon isn't good enough, but I start jumping up and down and getting more excited when I have 2 or 3 moons to line up. All right. Going back to that Aussie dollar, because there was definitely a retracement there. Again, just for cleanliness, let's take off this trend line. Let's take off this horizontal line, and let's look at this retracement. Again, daily chart, longer term traders, but not to say that a short-term trader can't trade off the same information. So Fibonacci's technical analysis, it's an art, not a science. Some people might put the low and use that low down here. I like to use the area, and I definitely see more of a congestion area here than this one spike down, so I like to use the averages, and I definitely think that this is a more clean area to put my bottom line. So let me shrink this down a little bit. So there it is. There's the move down, and here's how much we've retraced. Maybe here's my left shoulder. Maybe here's my right shoulder. So if I do some measuring, I'll throw in some new technical analysis here. Here's kind of my neckline. So 102.50 down to 10, and I gotta move the panel here to 101.05. So about 150 pips roughly. And from here, it should move another 150 pips or so to the upside. I'm just measuring out my head and shoulders 102.14 to 103.65, 103.70, we're right here. So at the 50% level, at an old resistance level right here, and the head and shoulders roughly, again, people will do it a little bit differently, but how I measure it out really quickly and really roughly, is this an area where it's too overdone to the upside and it's going to roll back down? The trend was down. It started retracing back up. Can I find enough evidence to be short here at the 50 mark, 103.73? And a lot of people will use the next Fibonacci level. If I get short here at 103.75, the next Fibonacci level is at 104.18. So that's about 45 pips. I'll put my stop above that. So I'm going to risk about 50 to 60 pips. My goal then would be for it to go from 103.75 down to at least 103 even in this area. Risk 75, 65 pips to make 75, 85, 100 pips. I don't need it to go down here to be a winner and make a new low. I just need it to move from here down to here, and that's my trade based on my risk reward, based on my analysis, fundamentally, technically, lining up a couple of different moons. That's how some people like to use Fibonacci's. They get in at one Fibonacci level and use the other one as kind of their exit if it breaks above that or below that, depending on which way they're going. Again, that's a longer term trade looking at lots and lots of data, about 2.5, almost 3 months of data here. But that doesn't mean that a short-term trader can't play this and say, I want to short here and I'll risk 20 pips to make 30 pips or 15 pips to make 25 pips, whatever it is, just knowing that there's some resistance area and kind of using that 50% level. So then they go down to their 30-minute chart maybe, and this is what they're playing. They might have taken this spike up to there, and they might have taken this trade right here. Get in right here at the 50% level because they were paying attention to the bigger picture, put their stop 20 or 30 pips above, and get out 30 or 40 pips below, and that's it. Come back in, maybe look to do the same thing and play this area. So interesting to see what the Aussie dollar does at this 50% level for sure. All right, let me just get back into the panel here. I'll press the wrong button here. All right, and just to see if there's any questions that have come across. All right. So let's look at one more pair. I can look at one that's not retracing that much. It's starting to retrace a little bit, but definitely not too much, and then we'll wrap up. But one that's been trending for sure. The U.S. Canadian. So again, when you look at the U.S. trending up, oil prices have been a little bit weak as of late. Again, the retracements, if I draw them on here, all right, we have a big move up, and let me draw that one more time. We have a, oops, let me draw that a third time. We have that's a pretty big retracement there. So a big move up here, and then it retraced about the 50%, 61% area. And then after that, I'm just going to leave that on. We had another move, again, a big move up. And again, we haven't started retracing too much. But again, a big move up, is it going to retrace a smaller amount and then head back up the next way? So the trend is up. And in this case, you'd probably be using the Fibonacci's maybe as a support to go with the trend. But again, you put in stops because, again, this isn't a holy grail and there aren't any guarantees. And you have to decide, why are you bullish at higher levels up here, the U.S. versus the Canadian dollar? So that's just something to think about, one that's had a good run as of late, and is it going to sit back, and can you find a buying opportunity here? So hopefully that's helpful to see me run through a few different pairs, run through some shorter term and longer term charts on using retracements and then building in trading plans for those retracements and acting as, again, support and resistance. So to wrap up, again, I thank you for your attendance tonight. To wrap up, links going forward. Quick review, fundamental events. Make sure you separate your macro and micro events and really stay on top of the macro events. Technical analysis, my 3 keywords: trend, support, resistance. If you can throw in an intermarket relationship, that's even better. And then retracements, tracking the pairs, drawing retracements, using them for short-term and long-term trading plans, and that leads to our resources. So I'll be back in about 2 weeks. The main topic will be the Q1. Can't believe we're already getting towards the end of March. Q1 review and a Q2 preview. That's the main topic. You have my email if you have questions. You have IBFX Education, their site. You have their Daily Forex Trading Edge, where myself and other analysts such as Raggy Horner are putting their daily market commentary together. I have about 3 dozen videos like this on various subjects on the IBFX YouTube page. And then, of course, you can reach me via my website, jupiterpeakfinancial.com. So with that, thank you very much again, and happy trading and invest intelligently. And I will be talking to you again in 2 weeks. Thanks.